Hi everyone, hope the market has been treating you well. Today I will be speaking more about an article which is put out on FX options. I will explain what FX options are, the various types of FX options, and some key differences between FX options and their more commonly known cousin, equity options, or otherwise known as ETO. I will then close off by highlighting some advantages and risks of trading FX options. So what are FX options, or FXO in short? FXO is just like equity options, which gives the buyer of the options the right but not the obligation to buy or sell a currency pair on a date in the future at a certain strike price. Key variables here are the same: call or put option, buy or sell, expiry date, and strike price. The biggest point you have to note for FXO versus a conventional ETO is that when you buy a euro-dollar call option, you are effectively buying a euro call and a USD put. As all FX prices are relative, it is always one currency pair against another. So let's go through some basic terms once again. When I say an option is at the money, in the money, or out of the money, what does it mean? So at the money, or in short ATM, is when the option strike price is equal to the FX forward price of the chosen expiry date. So let's say my 1 month FX option has a strike price of 1.05. So if the 1 month FX forward is trading at 1.05, my option is at the money. It is important to note that the reference price here is the FX forward, since options have an expiry date out in the future, as opposed to using the FX spot. So this is similar for in the money option and out of the money option, where in the money option means that when the call option strike price is below the FX forward price, or put option strike price is above the FX forward price. And in the case of out of the money option, it's when the call option strike price is above the FX forward price, or put option strike price is below the FX forward price. So next, I'll touch on the types of FX options available. So there are only two types of FX options, the calls and the puts. When you buy an FX option, you pay a premium, and when you sell an FX option, you receive a premium, regardless of whether it's a call or a put option. To illustrate this, we have included a scenario table which illustrates the profit and loss from owning a 100k euro-dollar forward versus 2-month call options and put options at a certain strike of 1.07 as the euro-dollar's forward price moves. You will see that the 2-month forward P&L moves up and down proportionately as the euro-dollar forward price moves. The P&L for buying call options would move in a similar way as well, minus the premium of cost of acquiring the option, which is $1,500 in this case. Both selling call and put options would yield you the premium of $1,500 as the best case scenario, and the P&L starts declining if euro-dollar forward goes above 1.07 after selling calls and goes below 1.07 after selling puts. Buying put options would make money if euro-dollar forward goes down, but only after accounting for the cost of buying puts. So now we will move on to buying FX options. Typically, traders who wish to buy or place a directional bet on a currency pair would buy out of the money options, whether it's calls or puts. As out of the money options are much cheaper and as a result offer the most leverage, it gives the most bang for buck. However, out of the money options are more prone to time decay, as they do not have any intrinsic value and are 100% time value. At times, traders might wish to buy at the money options. That is due to their sensitivity to the volatility and price changes in the underlying, and due to their higher delta, which is essentially their sensitivity to spot price moves, they are more likely to expire in the money. The downside is that at the money options are pricier and can lead to a larger loss of premium if the trade does not turn out well. Buying in the money options, on the contrary, is less popular if traders wish to place a directional bet on the currency pair, as they are usually a lot more expensive, and thus they offer very little leverage. Therefore, the advantage of buying in the money options is not high versus holding a spot position. Another way good traders can reduce their premium paid is via the option strategy, like using call spreads and put spreads. Next, selling FX options. So traders can generate income by selling FX options in exchange for a premium. As an option seller, you are going to receive premium to protect the option buyer from market moves. The max gain for you is the premium received, while losses can be unlimited. So if losses can be unlimited, so why do traders still sell the FX options? The reason is that market moves can be driven by sentiment that can sometimes overshoot, and option implied vol can be too high versus the reality of FX moves. Savvy traders can pick such points to sell FX options and receive premiums that they deem too expensive. For example, if you're bullish on an FX pair, say dollar yen, you can sell some puts at the strikes prices below spot. If spot is trading at 129, you can sell some puts at strike 125 for some premium. If dollar yen trades above 125, we do not have any obligation at expiry. But if it falls below 125, you will be long from 125. However, if you're bearish on dollar yen, you can sell some calls at strike prices above spot. So if spot is 129, you can sell calls at strike, for example, 131 for some premium. If dollar yen stays below 131, you have no obligations at expiry. But if it goes above 131, you will be short dollar yen from 131. So what are some of the key differences between FX options and equity options? The first is that FX options are traded OTC, or over the counter, instead of an exchange. As these products are traded OTC, variables like size, strike price, and tenor are customizable, unlike the listed options where they are standardized ones, like one option is equal to 100 shares for most of the US exchanges, and they only have monthly expiry dates. FX options are also European style options. This means that options can only be exercised on the expiry date as compared to any time before expiry in most US equity options, which are of the American style. And thirdly, when you exercise an FX option, the resulting position is a FX margin position instead of a position required to be fully funded by cash. For example, a 100k dollar yen call option expiring in the money will result in a long 100k dollar yen position that utilizes way less margin than 100k USD. If initial margin is 5%, then only 5k USD is required to receive this position at a strike price in addition to the position P&L. So what are some of the key advantages of trading FX options? The first is that the max loss is the premium paid. So buying FX options to express your view will not lead to margin calls and not lead to any mark-to-market losses beyond your account value. Secondly, selling FX options can lead to a steady stream of income via premiums to supplement the portfolio returns if you pick the right spots to do so. And thirdly, FX options can be used as a proxy take-profit order. It is not exactly the same, but if you have a long position on a currency pair, then selling call options can be a way to receive or generate some income until the trade works out in your favor. If it indeed goes above your strike price by expiry, you will simply square off your FX position via selling it at the strike price. If not, you would keep the premiums with no obligations. This can also be done as a stop-loss order where you buy a put against a long position and thereby protecting your downside below your put strike price. Now I'll go through some of the key risks of trading FX options. Firstly, the risk of unlimited loss is there when selling FX options due to the high leverage factor. Secondly, the risk of using FX options as a means to take profit or enter into a position can present some undesirable outcomes. So for example, the option might be in the money before expiry and turn out of the money at expiry, and therefore there is this path dependency risk that you need to be aware of. Without the option, you might have already taken profit or entered into a position via a spot order. And thirdly, buying far out of the money FX options frequently can lead to a low probability of success and too much premium loss on time decay. So on that note, we have come to the end of this series on FX options. Please click on the link in the description below to access the article, and I wish you all the best in your trading. Thank you.